Okay, this is Ken at Tortoise Capital. This is the nightly strategy podcast for September 8th, 2020. Um, what a beautiful tactical day we had today. So, Friday was the second day of the big sell off. It broke through Thursday's low, collapsed down below the Bollinger Band mean, and then staged a late afternoon recovery to come halfway up the stack. So, what we had was a sell-off on Thursday. Let's see, that was this large. And then the sell-off Friday was that large, but then had a rebound. And then today's ultimate sell-off was almost the same magnitude. So we've had three very large range days in a row. All 3 days have featured significant directional moves in both directions. Actually, Friday was a big move in both directions. Today was a big move in both directions. Thursday was just a big sell-off all to begin with. And so when we compare the last 3 days to the previous 30, 3 of these things are not like the other. That Wednesday push to the new 10-day high and 30-day high at 358 feels like a long time ago. We're $25 cheaper than that right now, which is almost, it is exactly a 7% sell-off from the swing high on Wednesday. And it closed very poorly. So there's not much joy in Mudville because now we're on the wrong side, or the south side. It's not the wrong side, it's just one side. We're on the south side of the Bollinger Band mean, halfway between Z0 and Z1, and closed poorly. So if we get another day tomorrow like today, this thing could get down and test Z2 and test the 30-day low, which was made almost 30 days ago. So the entire enterprise is now at risk. All we've done lately is just erase the last 10 days and really the last 20 days. But if we get one more day like that, we will have blasted through the Z1, the peak previous RL270 fair value, and we'd come down and test the 30-day low and Z2. So that would be a significant panic sell. And that would work, correction at least. And then this big red line here shows us the magnitude of a 10% sell-off. So that's 9.99, close enough. So this would be the 30-day low, the Z1. That's basically representing the 10% sell-off from the swing high. And again, that would erase the last 30 days of gains. It would bring us back to within spitting distance of the actual RL270 fair value. The last time it was there was when it tested this back in at the end of July, first day or so of August, when the RL270 came down, joined the dragon, and then price resumed this move up. So now when we look at this move, we can see this in terms of leg 1, leg 2, and leg 3. And now what took 27 days to build has been eliminated in 3. Or I should say what took 20 days to build has been eliminated in 3 days. So if we get one more day of like a washout selling, then it erases all the way back to day minus 30. So one scenario that you could see is a big gap down. So it closed here. You could see a big gap down followed by a bunch of buying pressure anywhere between Z2 and Z3, which would cause this to be some kind of amazing amazing rebound off a gap down and then a reversal intraday. That would not be impossible given how many of the indexes, as we're going to see, are in an oversold condition for channeling and for the overreaction, and there's some 5-day downs in there as well. So every swing system that we have is going to be firing because of the retracement. So all of our swing systems, except the washout, really are looking for bull moves to be established, and then more than just noise retracements, which then would set up the idea of this kind of a rebound. So all of the swing patterns are looking for exactly this kind of move right here. And because that statistically is a good idea, then anybody that's trading mechanical systems with conviction should be in the mood to buy this. So now the question really becomes, where's that pivot point going to be? Where is it going to give us another sell-off and then rebound? Or is that sufficient? So we'll see with the overnight trade how much buying pressure comes in and where it opens tomorrow. But whether it gaps down, to the previous peak 270 or the Z1, and it could do that very easily, because if we just take a look at the size of the gap, here was the weekend gap. It closed there and gapped down this far. So this thing could very easily gap down this far to the previous peak of the RL270. Whoop. What was that? Yeah, to the previous RL270, and then we might see, a move up from here, or it might be a gap up that takes off from here, and in either case, seeing a move of this magnitude to the upside would not be unusual. So this could get back tomorrow to the lower skin of the dragon, or taking out today's high without too much difficulty. So in these times of trouble, it's good to have an idea of the size of potential moves. So if I was a betting man, which I'm not, I would be betting on a gap down and then a strong possibility of a reversal. And again, that gap down could also just feature an additional sell-off like this back down to the down through Z2 and Z3. So a way to think about that is to put some kind of bracket. We might just say, hey, give me a maybe a $2 or $3 bracket around the open. Wherever that opens, and then play it as a hybrid frog. That is the way I'm going to play it. So I don't actually care where it's going to open at. I just know that tomorrow is going to be a large directional day. And then this will be tailor-made for a hybrid frog, which is agnostic as to which direction the price will move. It just makes a bet that the price is going to move large directional moves. And so what I want to say before we get into the analysis of the sectors is just how important it was to recognize that we were in the third leg of this move, 1, 2, and 3, and that the culminating bar to the upside was well beyond Z2. And we highlighted that at the time, saying that it's really abnormal behavior. And so you will recall, veterans of this podcast, how at each step along the way, we were making these measured moves to lock in pieces, so that when this thing started to sell off, we were happy to take that at 352 and not have to suffer those 3 days. And then cashing that nice move up in here frees the mind to be able to play the directional move and to follow price. So this is a case where that swing analysis and the intraday analysis really cooperate to provide a readiness and a willingness and the ability to trade in either direction following price. That is the essence of the hybrid trade, especially at key market turning points where the abnormal behavior, abnormal conditions, leads to standard work for abnormal conditions, and that is to no longer be just a buy-sider, but also to be prepared for sharp moves in the other direction. And we received plenty of warning from that based on the multi-time frame NDX was showing overbought on every time frame, and the risk Z had rolled over and was giving us some warnings. And just by analyzing the Z score of where price had found itself beyond Z2, that is really abnormal behavior. So even if you're not primarily a day trader, having a sense of where we are in the swing trade statistically gives you the ability to be prepared for these kinds of abnormal moves. So that's what tomorrow's trade looks like to me. There's a good possibility of a large gap, and then the larger the gap, the larger the expected follow through in either direction. Remember, our analysis of the gaps suggests that there's a correlation between the size of the gap and the size of the follow through, but that it doesn't predict directionality. So there's going to be two agitated traders tomorrow. One of those agitated traders is going to look at this and say, oh, a 7% sell-off is more than just a 5% noise, because this is the 5% noise, and today it voted down. So it's more than 5%, not quite 10% yet, which is this big red one. So it hasn't reached the 10%, but it's got most of the correction already built in. So there are some traders who are going to say, I want to trade it to the downside to take advantage of the final 3% of that 10% correction. And then if that happens and breaks the 30-day low, I'm going to be really large. So there's a guy that's really voting for the downside, trying to cause people to panic sell. Those are the kind of guys that take their positions now in VXX and are betting on the increased volatility to expand. That's a bold trade. And then there's another group who say the fact that there's a 7% sell-off and maybe more coming is that all of the things that I wanted to own that were showing the way to the upside that I didn't buy, I now have a chance to buy them on a 10%, or in the case of Tesla, a 28% discount. I mean, I want to own Tesla long term. Now I get a chance to buy it on a 30% sell. Why not? So those guys are all betting that the harsh sell-off is an exaggeration, and that creates the tactical opportunity to get back to the 10-day high, or at least halfway up the stack, which gets you back to 343 and the belly of the dragon. So both of these shorter-term traders are likely to be more active tomorrow than, say, earlier in the week. And it's only because of the exaggerated condition of an extreme up move followed by an extreme downward move, and that brings the sharks on both sides of that trade. So wherever this thing gaps down to, or wherever it opens at, whether it's opens where it closes, or it's a big gap down, or it could be a big gap up, these shorter term traders are likely to dominate that open 5, 10, 15, 20 minutes of trading. And so I don't expect any decisive, clearly dominant early morning direction, because I think there's going to be a lot of tactical give and take. But around 45 minutes to an hour to 90 minutes in, the smoke will have cleared, and we should start seeing who's winning in the rest of the day's trade. Is this tomorrow the opportunity to put in a turning point and take it back up, or was it just going to get crushed and continue to sell off all the way down to fair value, past 10%, past a 30-day low, past fair value, and then if it breaks outside of Z3, holy mackerel. Now you're talking about a 12 to 15%, and then way back at 305 was the last belly of the dragon. And now suddenly the entire bullish proposition is at risk. And then people will start seriously thinking about, is this another 40% sell-off that we're going to get before the elections because of how crazy things are going? Cities on fire, candidates losing their mind, serious people talking about a need for Department of Defense armed forces to enforce the rule of law domestically. That was not conceivable 6 months ago. But that's where we are. So, interesting times. All right, let's take a look at what we got going on today. We'll start with the upside, and the three U.S. indices that we want to speak of: diamonds, the Russell, and then the S&P. The S&P at minus 2.7. It has gone into daily fall. The Dow was a little better at 2.25. It's also in the daily fall. And then the Russell was the best at only minus 1.9, also in the daily fall. So daily fall conditions are really dominating most of the action right now. There's still a few things in summer, like Caterpillar, this Ackman's hedge fund, which was flat for the day. Simon Property Group is still in the daily summer. Materials, the VIX, Intel, finance, Walmart. So there are some things that haven't rolled over into the fall yet. But in terms of the U.S. indexes, best was the Russell, then the diamonds, and then the S&P, bringing up the rear at minus 2.73. Let's take a look at the symbols that, or the sectors that did better. So we had clean energy and Mexico at only minus 2%. We had a cluster here at about minus 1.6-ish. That was XLY. The consumer discretionary was a little better. Healthcare was a little better. Emerging markets were better than the U.S. Then Simon Property only down a quarter. Japan down minus 0.8. And then we start getting into the very few things that made money today. Treasuries now feeling like a little better play after all at 0.61%. So that support level for TLT at 160 held and is starting to make some gains. Caterpillar and Wheaton Precious Metals resisting the sell-off pretty well today and actually made a little bit of money, Wheaton Precious. which was better than silver. Silver was down 1.24, but wheat and precious metals was up 0.4. Caterpillar bucking the larger sell-off trend at 0.23. That's worth a study because that had to shake off the index weakness and the sector weakness. Caterpillar at plus 0.23 while XLB was minus 1.8. So that's not bad. Nikola Motors, just out of nowhere, 41%. Virgin Galactic, 9%. So there's some reasons to pay attention to these speculative, volatile trading vehicles. There's some opportunities to get some intraday momentum on lots of volume where our statistical patterns are giving us an edge. But that was about it for the day. Things that were better. Alcoa had a little fraction. It didn't lose quite as much. Cisco didn't lose quite as much as the S&P. Intel and finance, marginally better than the S&P. But now let's take a look at the Trail of Tears. So the S&P was down 2 3/4. Brazil down 2 3/4. Energy down 3.5. Technology, XLK 4.5, which means that, TECL, the triple, it was down 3 times that. We're down 13.3. And the triple Qs down 14%. Tesla down 21% to 330. So if you loved it at 500, I guess you must really love it at 330. Interestingly, it's still in the green for monthly summer, but it's on a daily fall. So the longer term trend is still empowered, but it's $170 off its swing high, which is 34% on sale. So if you're Elon Musk, you're riding a roller coaster there. So meanwhile, XOP, the oil sector, oil exploration, down 5 3/4. Oil itself down 6%. So energy 3.6, tech 4.5, oil exploration minus 5 3/4, oil down 6. And then the all-important FANGs, Facebook, Amazon, Apple, Netflix, Google, down 7%. So here's Tesla down 21, Devon Energy down 9, Apple down 6 3/4, Nvidia down 5.5, Microsoft 5.5, Amazon 4.4, Twitter 4, Facebook 4, Google 3.5. So plenty of tech leaders just getting out and getting assassinated, which contributes to that harsh sell-off in the S&P. So, the market gives and the market takes away. So you don't have to be right. You just can't stay wrong too long. All right. So on cataclysmic days like today, today was more like yesterday than it was the previous 30 days. So there comes a time when you are in the middle of normal. Let me draw a picture on this one. There's a point I want to make. I don't think that'll work anymore. Where is my little pen? There it is. That pen's not working. Okay. So I want to talk about normal conditions. And when you have normal conditions, you want to perform standard work. And when you have abnormal conditions, you want to perform standard work. Like when things around you are going crazy, you don't want to become crazy. You just want to use the standard work that is appropriate for those conditions. Now, this standard work is going to be different than that standard work, because if the same standard work applied to both of them, well, then abnormal would just be normal. So what we really care about then is the difference between normal and abnormal, so that when we use the rules for standard work, each one triggers a set of rules. And so maybe there's two rule sets. So how we describe that difference is connected to market classification. And there's a couple ways that we do that. There's that, the swing market classification. There's risk Z. There's the multi-time frame NDX, the 3, 10, 30, 90, 270. Each one of those gives us insights into different look-back periods. And so we can determine, and if each one of those represents some population and some buckets of money that are taking signals inside those time frames, then by scanning that whole sector, we can see how these guys are going up and down between manic and depressive. And that can give us some insights. We can look at the Z-score of price using the RLCO Bollinger Band frame of reference. And when things are within plus or minus 1 of average, we could call that normal. And when it gets above Z1 or below -1, then it's getting into abnormal conditions. But certainly, going out to Z3, sets up a range of normal that is useful for us. I might even argue that Z2 is a pretty good indicator, as we saw with the S&P. So if I went out to Z2 and Z-2, what we saw in this move was that price, the buying pressure had pushed it up to close above Z2, and we could treat that as abnormal. And so that triggered a set of rules, what to do under standard work. Tighten stops. Stop swing trading. Exploit day trading. Take the position that a bird in hand is worth 2 in the bush. So all of these things have to do with the estimate of risk. And so under normal conditions, our risk might be, well, watch it go from Z2 to Z2, and anything beyond Z2 is warning us that this thing could get crazy in a hurry. And then if it breaks below Z3, then it is genuinely risk on, and absolutely no doubt that it's abnormal. And so then all of these things that we were prepared to do become just the standard work for abnormal times. And then we can watch those adaptive statistical measures tell us when things are back to normal enough that we can shift back to standard work. Well, this whole package of market classifications is connected to the multi-time frame, multi-lens analysis, where we have 5 different models all of which help us understand the difference between normal and abnormal. So we have MACD, 4 seasons. We have the RLCO, Bollinger Band framework. We have the regression line fractal framework. We're looking at the difference between the RL270 and the RL10. And when that gets to an extreme condition, we know that there was some directional move that might want to snap and reverse. We can do support and resistance. And we can look at pinch and stretch. Are the Bollinger Bands expanding or are they contracting? What are the previous sizes of expansion and contraction? So those 5 lenses expressed over multiple periods of time give us the ability to do multi-time frame, multi-lens analysis. And then that gives us a mosaic, to use Robert Gardner's terms, a market mosaic that lets us adapt our rules, particularly in abnormal times. The more abnormal it is, the more careful you have to be with managing the risk, and it looks more like a one-off condition because all of the standard rules of thumb that help you when markets are moving up are no longer good when that thing has broken out of the Z2 or the Z3 box and this thing is selling off. That means that previous time frame has no bearing on the expectations of what's happening here. This is being driven by abnormal fear and greed. And so you have to go back to the last period of abnormal fear and greed and bring those insights forward. So that's what standard work in abnormal times looks like. It's knowing how to draw that line in the sand and say, nope, we are managing risk according to the new rules for abnormal conditions. So now the sizes of these moves are not even surprising. That's the kind of move that you expect under abnormal conditions. And so you just calibrate your moves accordingly. The nice thing about these 5 patterns is that they're all fractal. And so the statistical measures are adaptive to the increased volatility that we're experiencing. So standard work, rule sets, but then the market classification and systems analysis to tell us, are we in normal or abnormal? That's the essential decision. So let's take a look at some just normal standard work under abnormal conditions. So I've got this little situation here. So a couple things I just want to draw attention to. So you'll notice that we had a pinch and a pinch that we can infer from the rising RL270 that the previous move was up and strong, but we can also see that thing's starting to roll over. And then when we notice this getting towards the afternoon, then maybe that run is done. And then we're going to notice that the VWAP has gotten flat. And so now this move is at risk because this is where statistically that price wants to move back to. So now as I see this make a higher high in the summer, and now it rolls over at a lower high, and the summer has become fall, and it's getting near the the last 2 hours of the session. now I can see this pinch, and I can feel this starting to roll over, and it just made a move down to Z2. So in this little congestion zone in here, if it's going to follow the upward move that got it to this peak, but it's rolled over a little bit and stalls out, then that would be something like a follow-through move that would be consistent with the rising RL270. But if this run is done, then maybe this move, projecting the slope of the RL10 and the RL30 to come down this way, then the price could look like that. And if it's this far from peak to RL, or to the VWAP, excuse me, then coming down this far past it is certainly within play. So now this represents the potential downside move. This one, probably represents the upside move. And it's harder to believe in that because it's already had the intraday move back up was already in play. So now as I zoom in on this and get a little bit closer, and I'm framing this trade, what I'm really thinking is that the size of the previous move implies the size of a follow-on move. That the trade is in play, and whoever's going to win could win pretty big. So on the downside, what I'm looking at is if it were to break out, it's right here right now, if it were to break out of Z3, I'd like to be short. I can come back to the previous Z3 pinch and say, now, if it also broke below here, I could get a second position in. And then the next target would be the VWAP. And so maybe I want to get a third position in at that red line. So I've identified 1, 2, 3 possible plays. And then it wouldn't surprise me if this thing came down and then followed and just kind of filled in and then spent the rest of the day hovering around the VWAP. It also wouldn't surprise me if it fell this far and got down that far. And then, so that move could look like 1, 2, and then rejoin the line. And the idea here is that these collapses below support levels tend to happen fast and then stabilize, fast and then stabilize. Whereas a move to the upside, I might look to see, let me pick my first entry at a breakout of the PSAR and a crossing of the dragon, a second one at the Z2, which also takes out the peak of the RL10, and then if it breaks out above this Z3, then I could have my second, my third position. And then to the upside, because those are harder to believe in, it might look more like a grind, or maybe 1 grind, 2 grind, 3, if I got all 3 legs. The idea being I actually prefer downside trades because when they collapse big and fast. So now all I'm setting up is an afternoon trade that's taking advantage of this pinch after a move up that is starting to roll over. I've seen it in both directions. I've mapped out the price levels that make me want to buy. I've mapped out the price levels that make me want to get short. I've projected where those prices could move within reason. So I just don't know which of those angles is likely to be the case, but I'm also aware that out here by 4 o'clock, this VWAP is going to take on more and more importance. So there is sort of a signal saying, hey, remember, it's going to be 4 o'clock, and somewhere in here, all these guys have to exit leveraged positions. So that tells me that in the first half of this move is more likely to be the lucrative move, whereas this one is likely to converge. Even if it made bank, it's likely to converge back around the VWAP, all other things being equal. So that's the mindset that I have going into the tactical trade for the last 2 hours. Let me know if you found that to be helpful. So what I want you to do now is on your paper somewhere, if you wanted to get long, would you get long at 1, 2, or 3? Would you get short at 4, 5, or 6? Or would you pick a different place to get short? So I'm going to give you some time to construct. So let's say your trade architect came and said, hey, I got some business to attend with, but I've identified this as my yellow zone at a minimum. And I want you to construct a trading strategy. All right, so I'm going to pick for me, I'm going to pick long at 1, short at 4, and I'm going to use like about half a box, I think. So if it were to go out of the green line, then I would like to use probably half of that box as my stop, something like that. All right, so go ahead, lock in your ideas. Now, if you were, so I'm just going to track mine here. I'm short from 4. And I'm going to use I'm going to use a Wu Wei exit. I'm going to pick it up from the PSAR dot. Okay, so the price level that I need to see is like 3 dots, somewhere like about 3 dots. I'm going to say something like when the PSAR crosses the blue line, is when I'm ready to draw the vertical line. So when that PSAR dot gets below the blue line, then that's when I'm going to drop the Wu Wei exit down into here. Okay, so we're just going to keep that off to the side. And I reserve the right to lock in a sniper if I saw something that made me want to trigger, right? So I'm going to prepare my sniper just in case. All right, so here we go. Now you should be adjusting your stop as you see fit. Okay, so now I've got two dots below my entry, so it's just about, that's drawn to scale, not bad. So about one, if I get one more good move down, then that next bar, that PSAR is going to go to here anyway. I look at this and I just want to say, you know what? I'm ready to invoke my sniper probably already because it made this nice move down. I would not be offended then if you moved right now to lock in no lose plus dinner for two. So maybe like to the edge of the dragon, or where the PSAR is going to be on the next turn. So then I'm now starting to think about how to manage that trailing stop. And I'm going to probably, let's see, 3. And let's get a dotted line there. So if I take the Bollinger Band mean, if it's going to just follow that same, it's a slow moving thing, it's probably going to look like that if that Bollinger Band mean slope is about correct. Then this is what that might look like. That's my estimate of where it's going to be. Now, the other thing that I got to watch is if I go back and consult my trading plan, there's a second short position. Or was I saying I was deciding between 4, 5, and 6 on where to get short, or did I commit to first position, second position, third position? I love this as a second position because it just broke below the lowest low while in the trade, and this looks like a collapsing dragon. So I love that as a second position, which now means I wouldn't be offended if you moved your stop with that sniper to here on account of reasons. So now I can just leave that stop in play. Now I've got two positions in. And the Bollinger Band mean probably doesn't get activated until much later. So I will probably be involved in sliding this thing down with my sniper. But I could also just invoke the Bollinger Band mean, and as long as I'm just tracking where that Bollinger Band mean is, I'll be all right. All right, so I would plan by this time then to have a third position in if it breaks through 6 or the previous V, where the VWAP is. Okay, so here we go. That feels very good. This is almost, you could almost see this as another collapsing dragon, right? See, this one rebounded, it came almost to the edge of the dragon, and the PSAR then collapsed a leg. So look at the size of collapse. Leg 1, leg 2, Now this collapse only lasted 3 bars. It barely even penetrated the dragon and started to fail. So uh, a really aggressive guy could say, let me take it here instead of here, but I'd committed to this one. So, but on this basis, I might say, you know what? I'm going to slide this down to here and just take that one off altogether. And like, so right about there. But what I'm going to do is I'm going to move that to the edge of the dragon. And that's what I'm looking like. And I'm getting ready to activate this third. Like if it continues another leg down like that, I don't mind taking that third position. And as soon as that position is in, then I'm probably going to say, how fast can I get that to no lose plus dinner for 2? Now, you don't have to take that third position. But if you do, now that you've got 3 units of risk exposed, you might want to. Now, the question was, is the I stop on the second position based on the PSAR or the BB2? I use the same size as for position sizing, and the exit for the entire position is the same size. So it's still, if it was 200 shares, then the second one is 200 shares. They're all going to be 200 shares. Or if it was 1,000 shares, they're all 1,000 shares. Then the ASHUC asks, is the third position a market order or a limit order? I like putting the market orders in and just pull the trigger because I want to get filled right now. So by the time I'm looking to add the third one, I am personally flying that one. I've got my expert manager in now and not just the rule set. I don't mind the limit order for the second position, but by the time I got 3, when I'm going to put the third position in, that's my focus trade for that moment. Okay. So now we're going to be watching this. What is the price behavior when it gets to the VWAP? Because this was the natural move down. When we looked at this potential collapse here, we said, hey, this was sort of the reasonable target. Well, it's at the reasonable target. So what I don't want to do is give back too much of a reasonable move. Like if you don't put the third position in, I'm not offended because now you got 2 positions, they're deep in the money, and then whatever you capture in here, like if it's here, that's going to be a good trade. So you got to decide how much anxiety you want to manage. So I'm happy with my stop right here, right now. I would not be offended if you brought it all the way down to the edge of the dragon and you did something like that. But I'm content right now to be on the far side of the dragon. I have the dragon between me and price. We'll see how long that lasts. Bam. So I want you to notice again, we get almost like a collapsing dragon pattern in here. So let's count them. You had this collapse, a small rebound and collapse, bingo. This was not much and collapsed. This one didn't even get through the dragon and collapsed. It came through our third marker here at 6 in the VWAP. Now, the thing to notice on this is it would have been perfectly normal for this to have found support right here and then started to rebound. But because it came to the VWAP and then broke through, and now notice it just became winter again as this collapsed further. Now my thought is the size of this move is now the size of this move. So now this price is in play. So now I've got 3 positions in. Feels pretty good. We're this far. Now notice where this price has just moved down. This is where I probably want to lock in. Now I'm in the, so this was about here. Oops. So now I'm going to move my stop down to here. And now I want you to notice the Bollinger Band mean has started to get a little steeper down. So now if I extend the Bollinger Band mean, it is sloping downward, whereas this one, when we first started, was way up there. Now the Bollinger Band mean just got steeper down. So now my stop's going to look like that. Okay. Now the key point of this read is that we are on the other side of the VWAP, and that's why the size of this move, it can overshoot the same strength that it got above the VWAP is the size of the move to below the VWAP. You know, and technically, I suppose I probably should have drawn it this way. From peak RL10 down to peak. Yeah, so this is probably, if I'm being correct, I should probably draw it that way. Okay. So playing these symmetrical moves, this is where, you know, geometry is kind of in play. And in terms of volatility, just look at that RL, that Z3 line. As long as the expansion of volatility looks like that, then the downward pressure is still in play. And you can even notice you can see this red line is looking like the, which was the RL30. Now the RL30 is looking more like this. So you can see this is actually an acceleration to the downside because the RL30 went from there to here. So this is a move that's accelerating to the downside. Now, on this particular, when I see that big sell-off there, I am more likely to move this down to like here now. I want to lock in like this this consolidation area. Whoops, sorry. This consolidation and then collapse means that price is off the table. So I want to lock in those gains. So I'm likely to move that to there. You know, probably something like that. This should have been over further, sorry. So again, I'm not offended if you, and then you could, how much of that bar do I want to lock in? I want to lock in that much. And now I'm going to leave just the Bollinger Band mean in, whoops, that I care about. Sorry. That's the one I want to get rid of. So now this is probably looking like that. So that stop's going to be in play until the Bollinger Band mean picks up. Or I might decide that I want to just project the PSAR. And maybe that's now that I get 3 positions in, maybe this one represents my sniper. This is where my sniper exit is going to be. And this one is going to be where my manager's exit is going to be. So I'm tracking both of those patterns now. So if this price here were the bottom of the play and it came back here, bang, my sniper would be out and my manager would be out, something like that right now. I'm going to lock in another little piece. Oh, nice one. Probably to like here. This is where my sniper's getting paid. Oh, close. Now notice this one. Here's another one of those like collapsing dragon ideas. This one, this single spike up, didn't even get through the dragon. My stop was on the far side of the dragon, and then it collapsed another leg down. There's an argument that if you were going to put a fourth position in, you might have gotten your fourth position here. I didn't, but you could see how that happens. So now that it has moved down this another nice piece, I probably want to and all I'm doing is just following this step function down. Now maybe like right there. Does that feel correct? Kind of. Yeah. Now I want you to notice how steep the Bollinger Band mean has now gotten. It's gotten even further down this way. So now I've got to bring that down to here. And now notice the RL30 has become this steep. Whereas it used to be way over here. And the Z3 lines, which we had projected out this way, have gotten even steeper down. That's a runaway move to the downside. So now that I've got three positions in, and I got to the price level where I projected that if it just followed the rules of symmetry, it's now at the price level that it got to. So this is really abnormal gains on three good positions. So I really want to respect the fact that this is an anomaly and that my sniper exit here is locked in. So if the Bollinger Band mean stop is like right here now. So if I'm using the Wu Wei exit, I have the Bollinger Band mean at the red dot. I'm sorry, like right there. And then the sniper exit is down here. Is that making sense to you? Do you guys see that? And bingo, there's the sniper exit right there. And that's about a 1, 2, 3 exit. And now notice that what we have was the Z2 line has started to curl. The RL30 is bottomed out, but also the RL10 went from winter to spring, crossed the baby dragon, and warning, bingo, captured. By this time, the Bollinger Band mean, if I'm following that line, let me clear the deck for you here. Sorry, I meant to clean this one out. By this time, the Bollinger Band mean price level, the manager exit would be like right here. So I've taken half the position, and now my Bollinger Band mean exit is like here. And a bar later, we end up getting that. So our average exit on this is, the average price is like halfway through. So when we're computing this, and bringing this back, our risk box was this. And then our gains on the first position was from here to we're just going to call that the average exit. And then this one gained from here to the average exit. And then the third position goes from there to here. So when we start comparing the size of the risk versus reward, on those three positions, you can see that looks something like, I don't know, probably 10 to 15 execution R against that single initial piece of risk. So pretty tightly managed. And you can see how that combination of sniper and Wu Wei exit. I mean, notice how nice that Wu Wei exit was, just following the Bollinger Band mean all the way down. And then we were micromanaging the sniper to lock in pieces, and then got the blended exit. Okay. And so that's about 15R on that side. And I'm not going to go through all this again, but there is a supported spring crossing, which gives you this move. And then you have a collapsing dragon this way that comes back and tests the previous low. So there were, but by this time it's already, the day is over. So after this exit here, you probably don't take that one because there's only 45 minutes left in the day. You might have taken that one. Okay. So that's all set up by this the observation of where we were back here at that first yellow dot, and then computing reasonable moves on the basis of statistics and technical indicators, and then managing the the RLCO framework, the MACD seasons, support and resistance, and then using the Wu Wei exit strategy to keep us locked in. Okay, so that's what I want to cover there. That's everything I want to discuss tonight. The daily report is next. Let's just get that knocked out real quick. Might as well. That would be standard work. Hopefully you found that helpful. We've already seen the daily. Notice everything firing on the channeling and overreaction. Still bullish normal. Violently oversold. It's at below the 3-day and the 10-day NDX. Abnormally risky on the risk Z. Lots of auto framers firing. Lots of channeling and overreaction signals. These are the ones that made the big breakdowns. So Walgreens, Cisco, and Chevron were big breakdowns. But to me, really, when this much is collapsing, it's the market itself. So this is where I would probably be looking at the ETF tactical first. Lots of channelings. Tons of auto framers. Big breakdown here in oil exploration, primary target. Energy, which reinforces that XOP target. And then notice how smashed USO got. It's minus 60 on the 10-day and the 1-month NDX. And even the Qs really got assassinated today. Winners, gold, treasuries, and the defensive play of utilities. The biggest fallout of their own river, Microsoft, Gold, and Cisco. Cat was the oddball today. It actually made a little money. Strange. The auto framer, look, everything is so far from its 10-day high that you've got plenty of great symbols that frame out pretty well. Even the daily squeezes, these are the ones that had the least relative size of their ranges, but none of them are better than 2 to 1. So this is a directional move on daily and on daily charts, hourly charts, 2-hourly charts, and tomorrow you should be exclusively hybrid frog getting started because it'll be the 4th day of the sell-off and it's starting to get too easy to believe in the downside. And when you look back at how many signals are in channeling and overreaction, there's a lot of algorithms that are just buying the fear because they want to buy quality products on sale. So I think there's a good chance of seeing that tomorrow. But notice the dominance of the fall, spring, and winter. Not a single signal in the summer until you get over into the stocks, and then there's a handful of things. McDonald's, Caterpillar, American Express, Disney, and Walmart. Not a tech company to be seen, but the old reliables. Hamburgers, bulldozers, a bank, Disney, and Walmart. If that doesn't tell you who the five horsemen of the apocalypse are, whatever that means. Massive oversold on the NDXs of every type. So there they are again. AXP, Disney, DuPont, and Cat. There's McDonald's and Walmart. Everything getting smashed in the ETFs as well. Brazil and treasuries held off the best. The magnitude of that sell-off compared to the grinding upward. That was the anomaly. That was that price that was outside of Z2. We got the rollover here where the slope of the 30 period moving regression line broke over its 10 period moving average, starting to roll down. The pinch is back within normal conditions. So this little 3-day sell-off has tipped the RL30 over and made the RL10 panic. But look at the last 2 times that the RL10 got out of the yellow zone. There was strong rebounds here and here. So is there a possibility of a strong rebound here? Yeah, sure. The last time it got to the bottom of the river, it triggered a nice big upward move. So could that happen here? Yeah, it could. So yeah, that's what I'm trying to draw here just a second. Yeah, this little sell off to the bottom of the river, if it can find support there, then yeah, that could rebound in the same way that it rebounded before. That's why all those other signals like the channeling and overreaction are there. Finding support at the bottom of the river sets up some big moves. So that's where we are. That's everything I want to cover. All right, guys. I'll get this published and posted. I did a speed run of the swing portfolio that's already on Patreon and YouTube, so you can see that already. So that's everything I got for you. Take good care, and I will see you in the chat room tomorrow.